In this video clip, I'm going to look at the treatment of an intergroup transaction that involves the sale of an inventory in one company, but where the inventory is treated as a depreciable asset in the other company within the group. Now, before I look at the transaction, I just want to recap again what the aim is with consolidated financial statements. Now, I've summarized it there on the slide. Consolidated financial statements should only provide information about the financial performance and position of the group as a result of its dealings with external parties. So that is the reason why we adjust for intergroup transactions. Because from a group perspective, any profit or losses on transactions within in between companies within the group is, from a group perspective, unrealized profit and losses. So we need to reverse those transactions to fully eliminate the effect of intergroup transactions. Because in the end, you only want to reflect gains and losses resulting from transactions with external parties. Let's look now at the information in question 17.3b, where the subsidiary Lauren Limited manufactures items of machinery which are used as property, plant and equipment by other companies, including the parent company. So on the 1st of January 2014, Lauren sold such a property, plant and equipment item to the parent company for the selling price of that was $62,000, and it cost them $55,000 to manufacture. So from a group perspective, the combined results, when combining the subsidiary and the parent company's results, include an unrealized profit of $7,000, which need to be adjusted for. What is relevant from the information given to us is the fact that the transfer took place on the 1st of June 2014. The 1st of January. Let me just confirm that again. Where is it now? It's 13B. On the 1st of January, yes. And we're preparing consolidation adjustment entries on the 30th of June 2014. So that's 6 months before year end. So that's important because the parent company, Claire, they are going to charge an depreciation on a value of $62,000, because that is the value of the property, plant and equipment item in their accounting records. But for the group, the cost of the asset is only $55,000. So the group depreciation should be less than what is flowing through from the parent company's account. So it will be 20% of the $7,000 for half a year. That is the depreciation adjustment that will need to be made. We also need to consider the cost or the value of the asset item. Now, in the subsidiary, the asset was included as inventory. For the parent company, it will now lie on the PPE line, because that is what they use that piece of plant for, not as inventory, but as property, plant and equipment. So this is where the value is going to flow through, from the individual company. From a group perspective, it's fine that it lies on the PPE because for the group it just has been a reclassification from inventory to PPE. The group is more concerned about the value that it is included for. So the inventory had a cost of $55,000. It's included in the PPE at $62,000, but from a group perspective, the cost of the PPE is $55,000. So we also want to reduce the value of the PPE by $7,000, which is the unrealized profit. Now, the aim of the adjusting entries that we include in the consolidation worksheet is to move the values in the combined results that we get from adding the subsidiary results to the parent company's results to what the value should be from a group perspective. So with regards to the assets, we want to move it from what is flowing through in the parent accounting records to what it should be from a group perspective. So therefore our adjusting entry would be to reduce that asset value. Similarly, with the depreciation, we want to pass an adjustment entry to adjust the depreciation that flows through from the individual accounting records to what it should be from a group perspective. So the consolidation working entries are the adjustments to move us to the group results. So what do we need to include in the adjustment entry? It's first of all the reversal of the profit on the sale, but be careful, it's on the sale of inventory, it's not an depreciable asset, but it's an inventory item that has been sold. So we need to adjust for the unrealized profit on the sale of inventory. So of course that's going to affect your sales revenue and your cost of sales, as well as then the adjustment on the value of the asset. So that's the one part of the consolidation worksheet entry. The other part relates to the depreciation.